I have really had the privilege of intermingling personal and professional topics in my podcasts. I believe the personal speaks to exactly who I am, and I trust has added a vulnerability and a genuineness to each episode. I say all this to say I have spoken often and at length about aging. I often refer to aging as the number of days on this earth. The insight and wisdom these days have brought me. And I should say the insight and wisdom these days have brought me. Today, from a professional standpoint, I bring you the number of decades I have spent in this industry, the wisdom it has brought me, and now I can share it with you. I'm Susan West, District President of Fidelity National Title, East Florida, and I'm here to talk to you about my 3 decades in this industry. First, I want to talk to you about my career path, right? Where did I start? I started as a bank teller, and I want you to know that I balanced every day, and I loved being a bank teller. And in that role, there became an opportunity for me to be a receptionist in the mortgage department. I didn't know what a mortgage was, I want you to know, but I transferred over to the mortgage department, and I was a receptionist. And with that came an opportunity to be a processor, and I could not type. So they said if I went to typing school, they would let me be a processor. And those of you that have been in the industry as long as I have, we had to type promissory notes. They were 3, they were carbon paper, and you could not make a typo. You couldn't use whiteout. You couldn't backspace. There was nothing. You just had to get long paragraphs correct. And I really struggled at that. But I made my way through as a processor, came up to be a supervisor, changed banks, was in charge of the assumption modification department, and then I became department head. I was department head of the post-closing department, meaning after loan closings happened, the closing department, the closing process, right? And then delivery to the secondary market department. And that was the department that when the bank decided to sell the loans that they had made, I was in charge of delivering the package sales to the purchaser, essentially. This prepared me for my 30 years in title, right? So I don't know whether y'all caught that or not, but that part of my career didn't even include the 30 years in title. So now here I am to title. Sales, right, is where I started, sales management, and then I went to operational leader running the entire operation. But let's just talk about the conversation for me is how my sales perspective has really brought me much wisdom through the years of my career, through the decades of my career, right? I was able to literally boots on the ground, meet with people daily who did real estate business. I was meeting with realtors. I was meeting with lenders. I was meeting with builders. I was meeting with for sale by owners. I was talking daily about what we do and why people should use our company versus maybe a competitor. So a lot of boots on the ground, a lot of engaging conversations, and simultaneously working with our operations, our offices, to make sure I understood what they did for the client and to also make sure that they understood from my perspective, from my engagement, from my conversations, what the clients needed. So again, early on in my career in the title world, sales, boots on the ground, a lot of communication, a lot of engagement, a lot of learning as I went along. Somebody would ask me a question. I didn't even know what FSBO meant. Maybe some of you don't know, but I remember finally like 3 months in saying, can somebody tell me what a FSBO is? Well, FSBO, in case anyone's wondering, is a for sale by owner. But again, I say that to say, had to really learn as I was growing in the industry, which I loved. So that's really a key part of my growth. I took over the sales team as a sales manager, and then I was blessed with the opportunity to run the entire district, which brought back to me what I did in the banking world, right? Which was very operational, never had done sales in my life, but am a pretty darn good communicator. So sales came pretty naturally for me. But now in my career at this point, back in 2003, I was at a place where I was able to combine my operational knowledge from the bank, my operational knowledge from really meeting with to understand what we did from an office standpoint, and then my sales knowledge from the years that I did sales and the years that I ran the sales team. So I evolved. But what's interesting is my promotion to operational manager was in '03. And for a couple of years, like 4, 5, 6, 7, it was fabulous. We just kept growing year over year. And I would say the growth rate was above average because we have an above average team that works for us. But I would say that it was normal growth, right? And then '07 comes along and we start to feel some real downturn in our market as far as, or I should say, in '07, we start to feel some negative impact in our industry. The negative impact, you might wonder, what did it come from? Well, it came from, in my humble opinion and others' opinion as well, is that lending really at that point in time became, I think, less the credit worthiness, the standards for credit worthiness in the lending became less stringent. The need for verification of employment became less stringent. The need for equity in your home in order to purchase a home became less stringent. So there was, less guidelines in the lending world, and quite frankly, people that were getting homes, buying homes that would soon prove to not be able to afford those homes. And we started to see the results of that in '07 is probably better put. With that being said, speculative building, somebody's buying new construction, right? You're buying new construction. That first year, you're paying taxes on the land only. That second year, you're going to need to pay taxes on the improved land. Your taxes are going to go up. I don't think there was a lot of consideration for what is going to happen when this consumer who just bought this new construction home, what's going to happen? Can they afford, right, the taxes at the higher rate when improvements come through? So again, less stringent on the lending and less stringent on the down payment requirements, less stringent on equity needing to be in the homes. And where did we end up in '07, '08, '09 with people not being able to pay their mortgages? A little lesson for those of you, again, that don't know, a mortgage, right, is a lien against a property. The lien is recorded in the public records, and the mortgage gives the lender rights in the event the borrower doesn't make payments. In Florida, we're a judicial state. So what does that mean? It has to go through the judicial process, right, through the court system, the legal process, in order for a lender to foreclose. That can take years. So what did we see in our industry? We saw this happening. We saw the problems coming into play. We started to see more compliance in our industry, right? You could see it. If you were watching the news, you would hear about the compliance standards that they were putting into the mortgage industry, the closing industry. Anybody who's bought a home in the last couple years knows that we have a loan estimate that the lenders are required to provide up front. There's a closing disclosure that's required to be provided 3 days before closing and then again at closing. So there's just an opportunity for the consumer to really see what they're going to be charged and then what they actually are charged. So a lot more guidelines. The lenders on what they were able to lend and how they had to qualify buyers, that world changed as well. It tightened up, and we all felt that, right, in our marketplaces. But what came of it in addition to that is in 2011, in our world, we ended up literally opening an REO department. What's an REO department? An REO department is a real estate owned department. What's real estate owned? That's where a bank, right, or a lender has actually gone through the judicial process to foreclose on their borrower, and then they take ownership of the home. They own the real estate owned. And then in this instance, they had asset managers, and the asset managers would get with real estate professionals, realtors. They would list the home, sell the home, and then we at Fidelity, through our real estate owned department, we would manage those closings. We started out, and I'm not kidding, with one box of files that we received actually from our partners in California. I've spoken before about the fact that we're a national right? We're a Fortune 200 company. We're national. We have the greatest width and depth out of anybody in the industry. By the way, we're financially number one, both with market share and financially we're number one. And that is really something that we are very, very proud of. With that being said, one of my partners in California that works for my company, they had a relationship with a national lender. They gave me a box of files where we opened up a REO department, real estate owned department. We went from a box of files to 200 to 300 closings per month. That's the rate in which the foreclosures had gone through, the rate in which these lenders were listing their now real estate owned, and the rate at which real estate professionals were able to sell the real estate owned. And we would take the contracts and we would handle the closings. And by the way, those of you, if you ever want to learn more about title, handling an REO closing, one of the things we have to do is look at the foreclosure that the lender did through their attorney and make sure it was done correctly, because we're ensuring the new owner that no one else has interest in the property. So this was a very, very specialized department. And we went from 2011 to 2015 with this type of volume. And then things died down a little bit in the real estate owned world. And we then did what? We then created the same department and we just shifted a little bit and we began to serve the investors. The investors that we were serving, they were hedge funds. They were hedge funds that were coming to Florida, spending millions of dollars at the real estate auctions. You've heard this, homes for sale at the real estate courthouse steps, right? Literally, some figuratively, some were actually done at the courthouse steps. So the hedge funds would reach out to us and they would send us a list of properties that were going to be for sale at the courthouse steps the next day. And they literally wanted us to do what's called a pencil search to determine who the lender was, who foreclosed, was there another mortgage, what were the outstanding taxes. There were about 5 points we had to check. We had people working overnight where we would check that information so that we could provide the pencil search results to the hedge fund, and then they would decide whether or not they wanted to buy, which of those properties they wanted to buy. They'd bid. If they won the bid, they would be issued a certificate of title from the bank over a couple of weeks. And with that being said, now they own the property. At the time they owned the property, they would come to us for us to ensure their ownership, ensure they own the property. No one else has interest. We would create a new commitment and we would tell them, these are the taxes you have to pay. These are what you have to do now that you own the property. Now you have to do these things in order to make sure that your properties don't have liens or debts against them. We would do that individual properties, and then we would take bulk packages that these hedge funds would give to us. We'd do commitments, and then they would use that as a refinance, oftentimes either through their owner's policy or we'd issue a lender's policy, and we would issue that lender's policy or just give them the owner's policy, and they would use that as leverage to borrow more money and go back to the courthouse and do it all over again. This went on from, I'd say, 2014 to 2017. Then we saw 2014 to 2019, we saw where these hedge funds, all these different hedge funds that we had been doing business with, we learned so much during this time, by the way, but they were starting to almost swap, right, properties, portfolios. We did one where one hedge fund owned properties in Washington and the other owned properties in Florida, and they literally did a swap of ownerships because their portfolio, for whatever reasons they had, right, in their business model, they needed it to look differently. So we were able to do portfolio swaps. We were able to do bulk refinances. We did like a 1,500 property refinance where, again, an investor bought 1,500 properties and they wanted to package them all up to secure them against a loan to borrow more money to do it again and do it again and do it again. We had a fabulous time. We were busy. We worked really, really, really long hours during these years, and might have cried a little bit, but this was just part of, the evolution of this decade of what we were experiencing in the title industry. I want to let you know now what's happening in our investor department is it's interesting. some of the people that were employed at some of these large hedge funds actually broke out on their own and came down to the local markets and are doing business on a smaller scale. We see what we call double closings now. What's that? That's where I'm buying Mr. Smith's property and I do an earnest money deposit and have a contract with Mr. Smith, and then I've already sold Mr. Smith's property to Sally Johnson for a higher amount, and Sally Johnson has put down a deposit to buy. We call that a double closing. We have those. We have what's called an assignments. That's where I'm buying Mr. Smith's property, but I actually assign the contract and get an assignment fee to assign my contract to another buyer. We make sure at Fidelity National Title that all of these are compliant, that they're done correctly, and that nobody's doing anything illegal or cutting any corners to create any deception in these transactions. And we're ensuring the buyer, right, that they own the property and that nobody else has interest in the property. And when there's a loan involved, we're ensuring the lender of their lien priority. And everybody knows, because you're watching this podcast, that lien priority creates the ability to foreclose in the event the borrower doesn't repay the debt. So these are all the things that we work on now on our investor department. And I tell you all this because, again, you go back and you hear about, I did sales, right? In the beginning of my career in title, I learned sales. I learned communication. I learned how to build relationships. I learned how to build relationships with me and the client, right? The realtor, the lender, the builder, and then extend that to their client, right? The borrower, the buyer, the seller. And then I learned how to create relationships between that realtor, lender, builder, and my office team, and how to pass that off and communicate in a way. I believe this, right? Knowledge is power, right? Communication of that knowledge, that creates expectations, and expectations that are met breeds success. And I'm telling you this, if you have the knowledge of even bad news, if you communicate it well, you can create expectations and you can still have success. So I was able to do a lot of communication in that part of my career. And as I climbed the corporate ladder, and I say corporate ladder, but I want you to know about this again, Fidelity National Title, Fortune 200 company, great corporate company, but they allow the autonomy at my level to run these operations as if they're my own business. And I've talked about this in a previous podcast. I have 20 operations and I love what I do. So again, through the decades, we've also had economic issues. And one of my friends, she studied economics in college, and she was really so impressed that I was going to talk about this today. Let's talk about economics and how basic economics impact our industry. Let's talk about the concept of economic elasticity. What's that? It's further defined as the relationship between wants and needs. This economically impacts supply and demand. And as interest rates have increased, we all know that's happening right now, right? Interest rates are increasing. The home purchase now has shifted from a want to a need category. What does this do? This reduces the demand and increases the supply. So we have less of a demand on home purchasing, but we have a better supply. I told you this was going to be about the decades, right? So we had what? In 21, 22, we had a supply issue. We had more buyers than we had listings, and therefore buyers were willing to pay more money than what the home was listed at, and they were able to afford that because interest rates were lower. Interest rates are higher now. Now buyers are buying from a need perspective instead of a want perspective. And with that being said, our buyer habits have been impacted by this. The homeowner's been impacted, just your average homeowner like me, right? The investor, but also speculative builders have been impacted. And that's whether it's a local small builder, whether it's an investor building a couple homes at a time, or whether it happens to be a large regional or national builder. We aren't seeing where we're going to build a home and then someone is going to buy it. We're seeing where we have a contract and then we're going to build a home. So we see less homes being built, right? And then we also see less homes being purchased right now. With that being said, spring is right around the corner, and we do see some of the staleness or the stillness in the market. We feel an uptick in the residential market as we are rounding the corner to entering spring here. And also spoke with somebody yesterday, went to a commercial event, and they were talking about the fact that rates have stabilized, which makes everybody a little more comfortable. Everybody just has needed to tighten their budget, right? And everybody maybe is buying less home than they might have in 21 or 22. And the sellers are also having to step back and say, I possibly can't get for my home what I was going to get 6 months ago, but I can still sell my home. I just have to probably reevaluate the list price, right? So I talk about this, not to digress, but to say these are the decades, right? These are all the things that we've been experiencing in our market, in our industry, that we have not only survived, but we have thrived in it. And I'll also say this, technology has been our friend, right? It's been our friend because it gave us the opportunity to really sharpen the delivery of our product. And through COVID, we did get blessings through COVID. And our blessing was that we were able to deploy half of our employees to home, and we would figure out through technology how to be able to efficiently work with half of the team from home. We're all back in the office now, except for a handful of employees that it makes sense for them to work from home. But employee technology has helped us also thrive, right, in the markets that we've been faced with. So it's been a fabulous journey for me, 30 years, and I'm not going anywhere. I plan to continue to work in this industry in whatever market comes my way. And I really look forward to sharing more with each one of you, what I'm learning, what I'm doing, and what I'm experiencing. So this is just a little bit of my history professionally, and I hope you've enjoyed this podcast as much as you have enjoyed the personal ones that I have delivered. So thank you for listening to People and Profit with me. And as you know, I'm Susan West. And if you want more insights on leadership, how to thrive in the real estate industry, sign up for our monthly newsletter, The Recap, found in the show notes. And if you don't already, be sure to follow us on Instagram at @TheReframe_FNT. Thank you so much for tuning in.